Stocktake is brought to you by Intelligent Investor, Australia's leading value investing research house. Get your free trial by heading to intelligentinvestor.com.au. The information in this podcast is current on the day of recording. It is general advice only, does not take your personal situation into account, and may not be suitable for you.
Good morning, everybody. My name's John Addis. I'm the founder of Intelligent Investor, and you won't be surprised to learn that we have two guests this morning. The first of whom is Canadian Graham. Graham, Witcomb, how is Canada this morning? Is it surviving under Trump's tariffs rules?
Barely. It's very sunny and cold, so
nice.
Looks good.
Nice. You'll be pleased to know that it was 6 degrees here in Melbourne this morning. The weather in this city just drives me mad. We also have in warm and sunny Sydney, Gaurav Sodhi. How's your new house, Gaurav?
Oh, it's good. I've got the hose reel in, and everything's working so far.
The hose reel. You were talking about your lawnmower in our Monday morning meeting this week. So,
yes.
Welcome to the middle classes.
This is to keep the neighbours in check.
Come for the stocks, stay for the gardening tips.
We have two subjects this morning. The first we're going to deal with is annual general meetings. It's AGM season. Some of us have been going to AGMs and some of us haven't. There's a discrepancy in the team as to whether you should go or not. So I'm going to ask Gaurav to make the don't go case, and I will make the for case based on my experience at JB Hi-Fi last week. Gaurav, kick things off. Why do you hate AGMs?
I will preface this by saying I actually go to many AGMs.
I hate every minute of it.
But yeah,
that's actually true. I go to many AGMs throughout the year, and look, on balance, I probably get something out of it, but it's probably not consistent. And if I'm honest, if I had a real job and if going to AGMs was taking me out of my regular routine and it wasn't part of my day job, I'm not sure I would go, because you know what the truth is about AGMs? They are boring as shit. They are just boring. If I have to listen to another welcome to country, environmental,
our
keep your phones
plan
off, our safety, look, it's all fine. I know companies have to do this, but you want to think that you invest in this very special business, and you have all these reasons to think why the business you're going to see is better than all the others. And then you get to the AGM and you just find out that they're just the same. It really annoys me sometimes. They're just the same. They all say the same stuff. They all serve the same crappy biscuits. And it's just, look, I would still go, but I would say value your time. If you're a full-time investor, then you probably can go and not stuff up your life too much. But if you've got other things to do, then I completely understand why you want to give AGMs a miss.
Go for the biscuits and stay for the welcome to country. That's your view of it, is it? Graham, what about you?
You know what's worse? You know what's worse?
Here we go. The Rands is now building.
Some of these companies do podcasts and stuff, right? And then all the formality and regulation and rules that governs their listed life then starts morphing into their podcast life. They're now doing welcome to countries on podcasts. They're now talking, even on podcasts, the first thing they talk about is the safety performance. It's like, just
give me the money.
Give me the money. I didn't come here for the safety. Just tell me what you're doing.
All right.
Okay,
Graham,
all right.
Do you feel equally strongly? I mean, it seems as though Gaurav has a bigger problem with welcome to country than he does AGMs. But how do you feel about them? You obviously don't go very often, so you have to listen to them.
Yeah, and I prefer that, honestly. I think you can get through much more information more quickly. They usually can't, unless they're releasing something new about an earnings update. There's usually no extra information compared to the initial results release that you got a few months earlier. So there's a few retailers that will give an update on the first 8 weeks of trading or that kind of thing. But even that, if you're investing for the next 10 years, it doesn't matter what the last 8 weeks were doing. So I don't find that I gain very much out of AGMs at all. Sometimes it's good to hear the executives' voices and the tone compared to just reading from slides or reading.
All right, hang on, Hannah. I've got to stop you there. Okay, another rant incoming. Okay, this annoys me a lot as well. Everyone thinks they're an expert at understanding body language and tones. Let me tell you, you have no idea who you're up against. You know, these executives, these are masterful. They are trained and practiced at the art of telling you exactly what you want to hear.
And I think that's why when they're stuffing up, when they're looking nervous, you can tell that there's more to the story. I wouldn't take their positive statements as anything significant, but you can tell, I think, when they're feeling hesitant about something, or there's, I don't know, the slides say one thing, but they're obviously less enthusiastic in person. So
I'm skeptical.
I wouldn't take the positive, but
let me just hijack you for a little bit here, Graham.
You did that the last time you interrupted him. This is the second hijack.
The hijacking.
When they are useful, is you sit through these cringing, painful, excruciating AGMs one after the other, year after year, and you sit through them because every now and again you get something that's different. You sit through the monotony so you can pick up on the anomaly. That's why they're ususeful. When you start understanding the rhythm of these things, then something sticks out.
My case for me.
I remember when I first decided to buy Eagers was when I sat through I was in the AGM, and within 3 or 4 minutes, I looked around and I made eye contact with the friends I was with. And we all were nodding. We're like, yes, there is something special here. And we realized that because we've sat through dozens of excruciating AGMs. And when something different pops up, we're able to recognize it. So all that pain pays off.
Right.
It pays off eventually.
So, Gaurav, thank you for opening my statement to say that I think you're wrong, because I don't think that AGMs are any different than stock picking in general. You have to look at a hell of a lot of stocks to find one that you think is worthwhile digging into more deeply. And I think it's the same with AGMs. You have to go to a lot with the expectation you're going to learn nothing, maybe less than nothing, in order to learn something really valuable. I had that experience last week at JB Hi-Fi. We wrote a story on that last week.
Can you just go through that a bit more, John? I don't think people
Okay. Well, I'll start with an example that you told me when you went to the New Hope Coal AGM in the Hunter, would have been 4 or 5 years ago now. And you were there with the Milners in the pub, I think afterwards, and you said that it was really impressive. And one of the things that impressed me was the way that they, afterwards, the management team picked up all their dishes and took them back to the bar, their dirty dishes and their drinks, and took them back to the bar. Now, that's the kind of thing that I think gives you an insight into the culture of a business and the culture of the people. New Hope, they're contributing to burning up the planet, but they have very good manners. And that's something that's something that, is valuable to you. And I saw the same thing at JB Hi-Fi last week. I agree with you. Most AGMs are really, really dull. I listened into Woolies last week, and that was pretty dull, and it was a bit of a mess. And I think you can learn something from that Woolies AGM call. But there was stuff that happened at the AGM at JB Hi-Fi that you would not have learned from listening to the call or watching the video, or maybe would if the video. I don't think they produce a video. And one of the things was that there's a new CEO there, Nick Wells. It's his first AGM, and he stood up, and the first thing he talked about was how many pieces of electrical equipment the company had recycled in the last 12 months, and other renewable stuff. I think there was a welcome to country as well, Gaurav. That would have annoyed you. Maybe the recycling would too. But I've never been to an AGM where the renewables are mentioned first. Right now, if you go and look at the slides from that presentation, they're in there, but they're not first. But he said them first. And you go, well, would he have got sign off from the board to go with that first? And I believe he would have done. I don't think that a new CEO would stand up there and just do the presentation himself without running it past the chair. I think Stephen Goddard is the kind of chair that looks as though he's there to be supportive to a new CEO. And Nick Wells would probably have taken his presentation with him. And it was a sign of the board's support for their new CEO that they went with the renewables data first before sales and profitability.
It's funny because anytime I see that, when I see that first slide as being anything other than what our earnings per share did, it always makes me think they're hiding something.
That's right.
In this case, they don't seem to have been, but
me too. No,
I find that all distracting.
No, that's why it was good though, because you have that reference point. Normally this is a smokescreen. And it wasn't this time. It was a sign of support as to how a board goes about backing a CEO. And I asked one of the board members afterwards, what was the reason for that? And they said, that Nick just feels strongly about this. So, that's what he went with. So that was the first example. The second example there was the persona of Stephen Goddard, the chair. Like, he was thrown some fairly difficult and sometimes kind of annoying questions. He was calmness personified. He was exactly the kind of chair that you want, I think. He was measured, he was thoughtful, and he was respectful to every single question. And he looked in complete control. He was the kind of person, like if you were on that MD-11 that crashed last week at the UPS when the engine fell off, he's the kind of person that you would want in the cockpit, I think. And you don't get that from the call. You don't see that because you don't see his body language. And I think you can deduce things from that. If people get a difficult question, they get a little bit flustered, you can see it. You might not hear it, but you can see it. So I think that's another good example of why it's worth going to the AGM. And the third thing is what I referenced earlier, is that, it is useful to talk to directors and they're not going to, usually they don't say anything that interesting, but they do sort of drop things in casual conversation that they don't drop during the meeting. And you remember when Brambles lost all of those pallets? And they said, we didn't lose them, we just don't know where they are. and the chair at the time, I can't forget his name now, was former chair of NAB, Greg Hoffman, former research director, said, so what about those pallets? And he went, you're going to have to bleep this, Greg. Of course they're fucking lost.
I didn't know that story.
and that dishonesty, why not say it? Why not say these pallets are lost, right? You're prepared to tell people privately, say it publicly. That says something about him. It says something about the culture of the business. Those small signs, you don't get them very often, but when you do get them, I think that they're quite valuable, and you can only get them there in person. So my argument will be, if you're going to go to an AGM, go to your biggest positions. That will be the best investment of your time. You don't have to worry too much about the small ones, but go to the biggest positions. And I think that you're more likely to learn stuff from small companies than you are from big companies who, for the reasons you said, Gaurav, and you, Graham, they are media trained to the nth degree. But if you go and collar them afterwards, they let things slip, and that can be valuable too.
I'll just add one thing to that, John, and that's that the chairman being calm and in control. There are some very good chairs, and I'll point to Rob Milner, right? If you go to a Milner meeting, he's ruthless with questions, and often quite dismissive and rude with questions as well.
Yeah,
and that's just the personality of the chair.
Yeah,
and I think that goes to the no bullshit to get things done attitude of the Milners.
Yeah, I haven't got any problems with that. I mean,
yeah. So,
right? I think Stephen Goddard is being authentic.
I think that's where I was going. Yeah. I think what you want to look for, rather than a set of characteristics, you want to try and find authenticity. Is this person in front of the microphone the same person as behind the microphone? That's the sort of thing you sort of want to look out for. And there are some directors who are just there for the title, know nothing about the business, do not care. You come across those quite a bit as well.
Yeah.
Especially, I've got to say, especially in sort of these mid-cap, smaller companies.
Mm-hmm. Because the CEO is often the founder, and they want to have a compliant board.
Or they need a compliant board. Exactly. So you want to suss that out as well, because look, to make your point even more strongly, John, one of the great benefits of seeing an AGM is watching that interaction between CEO and chair, CEO and board. That you don't always know what you're watching, but if you watch enough of them, you start seeing patterns, and things that deviate from the pattern really stand out. If the CEO and the board don't get along, or the chair is the one who's really in charge, you go to a Lavisa meeting, for example, there is no doubt who's running that business. It's not the CEO. It's the chair. He's the main guy, but very different from I imagine from a JB meeting or a New Hope meeting.
Well, thanks for making my case. I thought you were going to be arguing against it, but I think we ended up in the right kind of place. Graham, have you got anything to add?
No, I think you can use them as a negative selector. I really dislike any managements that use
that's a good idea.
Promotional language. So they are good for finding companies that kind of over promote. If you get the sense that they're selling to shareholders instead of to their customers, then that's a bit of a red flag. And you usually only get that from meetings.
I like that idea, Graham, of using it as a negative screen. I think that works quite well.
Right. Okay. Well, I'll see you all at the Lavisa at AGM next week.
With biscuits.
With biscuits. All right. We're going to take a quick break, and then we're going to return with the second appearance of Rob Milner.
Looking to build your investing confidence and discover new ideas? Join Intelligent Investor at ASX Investor Day in Melbourne this Saturday, the 15th of November. It's a full-day event packed with practical sessions from leading investment experts. Catch Intelligent Investor's Deputy Head of Research, Gaurav Sodhi, on the top investment ideas and stock picks panel. Tickets are on sale now. Just Google ASX Investor Day. Make sure you use the code NOV25 to get 20% off your ticket.
And we're back. And now we're going to talk about Soul Patts, which is often called Australia's Berkshire Hathaway. I'm actually going to start with Graham here because, Graham, you're not the analyst on this stock, but have you got any idea why people refer to it as Australia's Berkshire Hathaway?
Well, I think it's because it's a conglomerate of lots of different things and it's done very, very well over a long period. It's probably that simple.
Hang on. Let me argue with that because Wesfarmers is arguably maybe even more successful and equally a conglomerate, but that's certainly not described as a Berkshire. There's something else.
Why is that?
Because Berkshire is associated with permanent capital, with long-term permanent capital, and that's what Soul Patts is. Yeah. Wesfarmers is more of a private equity. Yeah, we'll buy an asset, we'll fix it up, we'll sell it, we'll change our portfolio. Soul Patts has owned basically the same portfolio for sort of 30 years. A lot like Berkshire, and so the comparison comes from the conservatism, stability, and permanence of the portfolio.
Yeah, I think you're right.
Yeah. Okay. Now, in your story last week, Gaurav, you described Soul Patts as a kind of nightmare for a certain kind of investor. So why is that? Isn't that a bit of a red flag?
No. That's the opportunity, John. I find that. Because this is such a competitive field, right? And there's so many resources and tools available to the investor. You need to find stocks that confound the many, but delight yourself. and Soul Patts falls very neatly into that category because it screens terribly. You know, most investors are looking for the same sort of characteristics, and we all know what those characteristics are. They're looking for high ROE. They're looking for low debt. Looking for profit growth, high margins, and all those things, which independently they're all very, very good. No one's disputing that. But very rarely will you find all those characteristics clearly and an attractive price altogether. So you got to do some work to actually find opportunities, and that's why Soul Patts is attractive because it screens awfully, and it does that because it owns stakes in companies, and so. If it owns 19% of a business, that asset sits on the balance sheet, dragging down return on equity, but there's no associated profit from that asset unless it's paying a dividend. They get a bit of cash from it, but it's not like they report 19% of that business's earnings on their own books. So it always looks like it doesn't earn very much money, and the cash flow it gets is really just cash from dividends, but the individual stakes in those businesses that it owns are sort of growing and compounding, and it's not always obvious on the books.
Okay, so you explained how it's a complicated business for the reasons you've just said. It's at 40 times earnings. It's paying less than a 3% yield. It doesn't screen well, as you said, on other metrics too. So the attraction is the history of this business and the fact that it's grown at double-digit rates for 20 odd years. No business on the ASX has been more consistent with dividends, but is there an opportunity there now? And if so, what are the stocks that are driving it right now in the portfolio?
Yeah, the big change has come because Brickworks, which had a long time had a cross shareholding, Soul Patts rather had a cross shareholding with Brickworks. They've now consolidated that cross shareholding. So Brickworks has effectively been taken over by Soul Patts, and it is now a subsidiary of Souls. And the shareholding that Brickworks owned in Soul Patts will be collapsed as well, and just dramatically increases the free float of the business. It means that 100% of Brickworks' earnings are now going to be inside Soul Patts, and the most attractive part of that business is this property portfolio, this property joint venture that builds and develops industrial property. And that's been growing for many, many years. And I actually think it's deeply undervalued inside the Brickworks portfolio. And so having full control of that.
Hasn't that been the case for a long, long time?
Yeah.
I mean, I remember hearing about Soul Patts and its undervalued property portfolio for years and years.
Well, it's Brickworks' undervalued property portfolio. That's why Brickworks has been on our buy list for more than 10 years. It spent more time on the buy list than off it. And it's been consistently there for that exact reason, because it's got this wonderful property business, joint venture with Goodman, and the rents are below market. So at some point they will be there'll be a new benchmark for those rental rates, and there's just so much. There's decades of growth ahead in developing old brick pits into industrial property. And now that all goes to Soul Patts and has more liquidity in the share price as well. So that helps too. But
so do you think that cross shareholding was holding that value back then, or the discovery of that value back?
It was. There's no question. It was there to stop takeovers, because both companies have such a long-term horizon. They're willing to sit through cycles. They were vulnerable to private equity coming in and breaking the businesses up at a low point of the cycle. So the cross shareholdings were there to protect against that. But now I think Soul Patts is large enough that its size probably offers some protection in itself.
Right. Okay. So how do you feel about the rest of the portfolio outside the land bank, if we call it that?
Yeah, well, that's been the big change. The rest of the portfolio has been humming along as it often as so long has. I think they've owned the same collection of stocks for between 20 and 30 years. These very large stakes in businesses that we're talking about, Brickworks, TPG, 2S, and there's probably another one I'm forgetting there as well. But they've owned these, and New Hope. Thank you. Yeah, they've owned New Hope for, I want to say, it's almost 40 years.
Wow.
And it's just been a wonderful cash generator for them over that time. They have pivoting the portfolio a little bit more into private equity, unlisted businesses, and credit. Credit is certainly a hot market at the moment, but just the long-term approach that Soul Patts takes to these assets, I think that's the differentiator. A lot of competitors are trying to, they have lockup periods for 3 years or 5 years, and they're trying to maximize returns over that 3 to 5 year period, whereas Soul Patts really promises permanent capital, and it's able to attract investments that other people probably can't get access to.
Isn't that in the price though?
Look, it's not cheap. You're right, John. It's not cheap, but I do think if you're a long-term investor and you sort of, you're happy to sit through cyclical highs and lows, then this is a stock that you almost have to have in your portfolio, I think. And I think one of our members actually put it best. Peter mentioned in one of the comments that it's almost, Soul Patts is the closest thing we have to a one stock portfolio. And I would agree with that. If you only want to own one stock and then hold it for the rest of your life, it's probably going to be Soul Patts.
Yeah. So, and that's why people call it the Berkshire Hathaway of Australia, I suppose, because there is a little bit of premium in the management and the people you get running those businesses. It's a 13 billion portfolio and it's got a market cap of 14 billion. Graham, does that sound like a good deal to you? Is this the kind of stock you want to die with?
Or die trying with?
in your tragic skiing accident?
Oh, jeez.
This has gotten very dark, John.
I know. Didn't get any
Probably
sleep
more
last
likely
night.
to be some sort of overeating donut extravaganza. Clogged arteries. It is a great stock, though, and I'd be happy to own it for a very long time.
You own Berkshire, right, Graham?
Yeah.
Have you ever
the American Soul Pats?
The American Soul Pats. Have you ever sold a share of Berkshire?
I have sold over bits and pieces over time as I needed to raise the money, but yeah, not because I thought it was a bad deal ever.
Yeah. Look, this is something that that Greg, our former research director, has really hammered into me, and I think it's really vital that investors tend to maximize for the rate of return. You know, for the yearly return, that they pick stocks and sell stocks to try and maximize that yearly return. But the mathematical equation for returns, the exponential factor is time. If you can, you're much better off over time holding a business that can compound at a lower rate over a longer time, rather than the business that compounds at a higher rate over a shorter time.
Yeah, and all the studies support that.
Yes,
it's just a question of selecting the right stocks that you're happy to own for a lifetime.
Well, nothing
and
personifies
then
that
not selling when they crash, and just hanging in there.
This is the perfect example of that stock. It will never appear on the list of the top 5 performing stocks of the year, or even on the top 10 best performing stocks of the year. But it will compound consistently year after year, and you can have faith in management. They've got such a long and tenured record. This is one of those stocks where the time actually does the work for you rather than the rate of return.
All right, so there we've got it. This is a stock to own for decades, a stock to give to your children.
Yep.
And a stock run by people with very good manners who clean up after themselves. What more could you want from a business?
Although,
I think we're going to Sorry,
he does swear quite a bit.
That's
old
okay.
Rob.
I think it's
that adds to the excitement.
I'd love to be able to say on this podcast. All right. On that note, I will leave it there, and we will leave it there. Canadian Graham, thank you very much for your time. I know you're either up late or up very early. It's one of the two. I never know which. Gaurav, thank you again, and we will see you all in 2 weeks' time.